Hello and welcome back to the channel. Remember March 2020? The market crashed 34% in just 1 month. Or how about 2008, when it took years for people's portfolios to recover? Every single person who buys stocks lives with this quiet fear in the back of their mind. What if it all crashes again? Now, most people deal with this fear in 2 ways. They either become paralyzed and keep all their money in cash, missing out on growth, or they just ignore the fear, cross their fingers, and hope for the best. But there is a third way, and no, it's not selling everything and hiding under your desk. It's a strategy called the protected put. Think of it as real insurance for your stock portfolio. You pay a small fee, called a premium, and if a market disaster strikes, you have a safety net to catch you. In today's video, we are going to demystify exactly how protected puts work. We'll walk through a real-world example of what it costs to protect a portfolio, figure out when it's actually worth it, and reveal the inconvenient truth most online gurus won't tell you about this type of insurance. Let's get into it. To understand a protected put, let's start with an analogy everyone gets: car insurance. Imagine you just bought a new car for $40,000. That's a huge investment. So what's the first thing you do? You get insurance. You pay an annual premium, let's say $800 a year, to an insurance company. Now, in most years, nothing bad happens. Your car isn't stolen or totaled in an accident. Did you lose that $800? Of course not. You paid for peace of mind. You paid for protection against a financial catastrophe. And if the worst does happen and your car is destroyed, the insurance company pays you its value. You aren't left with a $40,000 loss. The insurance limited your maximum loss to just the premium you paid. Okay, now let's translate this to the stock market. Your car is a stock you own. Let us say you have 100 shares of Microsoft that you bought for $400 each, a $40,000 position. The insurance policy you buy is a put option contract. The insurance premium is the price you pay for that put option. And the insurance company, well, that's just the market, another investor on the other side of your trade. By buying this insurance, you are buying the right to sell your Microsoft shares at a specific, pre-agreed price, on or before a specific date, no matter how low the stock has fallen in the real market. That's the whole idea. You are protecting the value of your investment against a catastrophic drop. Let's put some real numbers to this to make it crystal clear. Here's the scenario. You have a concentrated portfolio, 100 shares of Tesla, which you bought at $180 per share. Your total investment is $18,000. Today, Tesla stock is trading at $250. You're sitting on a nice unrealized gain of $7,000. You're bullish on the company long term, but you think the next 3 months look pretty turbulent. There are elections coming up, inflation reports, and Tesla's stock chart is at a key resistance level. You want to protect your gains without selling the shares and creating a big tax bill. So, step 1 is to buy the insurance, the protective put. You log into your brokerage account and buy one put option contract for Tesla. Each options contract typically covers 100 shares. You need to choose a strike price. This is the price you want to be able to sell at. How much protection do you want? Let's choose $120. This guarantees that in a worst-case scenario, you can sell your shares for $220 each. For the expiration date, let's choose 3 months from now. Short-term options are generally cheaper than long-term ones. Now, the premium, the cost of this insurance. This $220 strike put with 3 months until it expires might be selling for about $8 per share. Since one contract covers 100 shares, the total cost of your insurance is $800. This cost is immediately taken from your account. It's the premium you paid, and just like with car insurance, you don't get it back. So, what can happen over the next 3 months? There are 3 main scenarios. Scenario 1, the crash you feared actually happens, and the insurance pays off. Let's say Tesla's stock falls hard, all the way down to $180. Without the put, your position, which was worth $25,000, is now worth only $18,000. You've lost your entire $7,000 gain. That hurts. But with the protective put, Your contract gives you the right to sell your shares at $220. That contract is now very valuable. You can exercise it and sell your 100 shares for $22,000, even though they're only worth $18,000 on the open market. Your final result, $22,000 from the sale, minus your original cost of $18,000, minus the $800 premium. That leaves you with a profit of $3,200. The stock fell 28%, but your portfolio is still profitable. The insurance worked perfectly. Scenario 2. The market rises, and the insurance expires worthless. Let's say Tesla's stock soars to $300. Your $100- and $20 strike put is now useless. Why would you ever sell at $220 when the market is willing to pay $300? So, you let the option expire. You lose the entire $800 premium you paid. Your final result, your gain on the shares, is $50 each, or $5,000 total, minus the $800 premium, giving you a net profit of $4,200. Think of it this way. You spent a small percentage of your position's value for peace of mind. It's like paying for car insurance and not getting in a crash. You're probably pretty happy because your stock went up. Scenario 3. The stagnant market, which really highlights the pure cost of this protection. Let's imagine Tesla's stock closes at exactly $250 at expiration, right where it started. Your put expires worthless. You lost the $800. Your stock position didn't gain or lose value. Your net worth has decreased by $800 purely due to the cost of that insurance. This is the ongoing cost. If the market just chops sideways for a long time and you keep buying these puts, the premiums will add up and steadily eat away at your returns. So, are protected puts the answer to all our prayers? Not exactly. Like any financial tool, they come with real costs and complexity. Let's weigh the pros and cons with brutal honesty. First, the good stuff. Why this is such a powerful tool. Number 1. Define peace of mind. You know, down to the dollar, what your maximum possible loss is. This takes the emotion of panic completely out of the equation. Number 2. It allows you to stay in the game. You can hold on to a long-term stock you believe in, even during very risky periods, without feeling forced to sell. And number 3. Customizable protection. You can choose the exact level of protection with the strike price and the duration with the expiration date, tailoring the cost to fit your budget and your fear level. Now for the bad and the ugly, the things the course sellers don't always tell you. Number 1. It's expensive, and those costs compound. Short-term protection can easily cost 2 to 5% of your position's value every quarter. Over a year, that can eat up 8 to 10% of your potential returns. That is a heavy tax to pay for safety. Number 2. The renewable insurance dilemma. What do you do when your put expires? If the market still looks risky, do you pay another premium? This cycle can be financially draining over time. Number 3. It's a tactical band-aid, not a long-term strategic plan. If you feel like you constantly need to buy protected puts, your asset allocation might be wrong in the first place. You might just have too much money in volatile individual stocks. Diversification is a much cheaper, more permanent form of protection. So, the million-dollar question, is it worth it? Here is the sensible investor's checklist. You should only consider using protected puts if it's a tactical move, not a habit. You're protecting a large, concentrated position during a specific, known period of risk, like right before a highly uncertain earnings report. You're protecting big gains, not just your initial principal. You have a significant unrealized profit that would be painful to lose, and selling it would trigger a large tax bill. And finally, you understand and accept the cost. You have to see the premium not as a loss, but as a risk management expense, just like your home insurance premium. Do not use protected puts as a crutch for a poorly built portfolio. If the cost of these puts scares you, and frankly, it should, there are cheaper alternatives. They are less perfect, but far more economical. The first alternative is a simple stop-loss order. This is an order you place with your broker to automatically sell your stock. If it hits a certain price, it's almost free to use. The problem? In a real market panic, the stock can crash right through your stop price before your order gets filled, resulting in a much larger loss than you planned. And once you're sold, you're out of the game, even if the stock bounces right back. The second and most important alternative is diversification. This is the absolute #1 undisputed form of protection for most investors. Spreading your money across different sectors, countries, and asset types means that when one thing falls, something else may hold its ground or even rise. It's like insurance that's built right into the structure of your portfolio. The third alternative is using ETFs instead of individual stocks. Protecting 100 shares of a broad market ETF like SPY is much cheaper, percentage-wise, than protecting 100 shares of a single volatile company. The volatility is lower, so the insurance premiums are lower. So, what's the final verdict? Protective puts are a surgical tool. They are for experienced investors dealing with specific concentration or timing problems. For most of us, building a diversified, resilient portfolio from the very beginning is a much smarter insurance policy, one that's cheaper and never needs to be renewed. To quickly recap, a protective put is portfolio insurance. You pay a premium for the right to sell your shares at a guaranteed minimum price. The upside is peace of mind and defined protection against disaster. The downside is the high, recurring cost, which can seriously erode your long-term returns. It's mainly for investors with large, concentrated stock positions who are facing a known, short-term period of risk. It is not a permanent solution. Ultimately, the greatest insurance you can buy in the market isn't an option contract. It has the knowledge to build a strong portfolio and the discipline not to make decisions based on panic. Next week, we're going to the opposite end of the risk spectrum with a strategy that actually thrives when the market does absolutely nothing. We'll be talking about iron condors. Until then, invest wisely. Thanks for watching, and I'll see you in the next video.